It is rare that a month goes by in which I don't hear from someone about a problem they're having with their life insurance. The problems usually arise with universal life policies that were purchased 10 or more years ago. However, lately we've seen a relatively new variety of universal life known as indexed universal life policies being sold. If designed improperly, these policies may potentially be setting up for future problems. Universal life is a type of insurance policy that, if designed and managed properly, can be the most strategic life insurance policy that one could own. However, this type of policy could turn into a financial nightmare if not handled correctly. In our experience, universal life policies are sometimes more appropriate for clients than the typical term life or whole life policy. The strategies we use and situations we deal with may provide you with a better understanding of the universal life policies and how to make them work for you. If you currently own a universal life policy, also known as ULs, or are contemplating the purchase of this type of life insurance, there are certain concepts you must consider. You need to make sure that it is working for you. Is it still meeting the objectives you wanted when it was originally purchased, and have those objectives changed? For instance, when we run into existing universal life policies, the conversation usually begins with a client asking questions similar to these. Why are my life insurance premiums going up each year? This life insurance policy is becoming so expensive. Why? I thought this policy would be self-funding after 20 years, but that doesn't seem to be the case. Why not? Or, I bought a whole life policy, but it says universal life on the statement. How come? Our first step when dealing with this situation is to help the client understand the difference between term, whole life, and universal life policies. The next step is to address their problem. Like we would with a client, let me first give you a very brief and general explanation of the three types of life insurance policies as it relates to premiums: term, whole life, and universal. Please understand that this is the most simplistic review of life insurance types that we could give. For the sake of brevity, we've really simplified it. Term life insurance, the payments are the same each year for a set period of time, usually 10, 20, or 30 years, and then it goes away. Whole life, payments are the same each year for the entire life of the policy. And finally, universal life, payments are flexible and can be adjusted each year. It is this flexibility of the universal life policies that can lead to poorly constructed or poorly managed policies and have them implode. Of course, not every universal life policy we encounter is problematic. In fact, a properly designed universal life policy can be the most appropriate solution. However, for now, I'm going to focus on the policies that aren't working. The most common problem is that in order to keep the policy in force, the client is being asked to make increasingly higher payments each year. If they don't make the higher payments, the policy is going to lapse or go away. In other words, the policy is imploding and the premiums are exploding. The main reasons we find universal life policies are failing people. Number one is poor original design. When creating universal life policies, premiums are determined by a variety of factors, one of which is the interest rate that we provided on the cash value within the policy. Most of the universal life policies we come across were issued in the 1980s or 1990s. At that time, interest rates on many things, including life insurance policies, were high relatively to today. The original premiums were often designed with the misguided belief that those relatively high interest rates would continue indefinitely. As a result, the cash value didn't grow as quickly as expected, and the ever-increasing cost of insurance chipped away at that cash value. These policies were simply underfunded, and a cash cushion was never created. These policies were designed with non-guaranteed and incorrect hypothetical numbers. The second problem is payments adjusted downward. Perhaps when the original policy was issued, the insured was comfortable with the premium payments. However, things change. The ability to lower payments in a cash flow tight time is a great feature of universal life policy, but it can also cause the policy to unravel. If your payments are lowered, they're expected to increase back in the future when the policy owners are back on track. Unfortunately, many owners don't readjust. They just wait too long to adjust and find themselves in a situation where the premiums or the cost, just to keep the policy in force, are much higher than they wanted. Often owners underfunded the policy from day one and never knew it. Number three, loans taken against the policy. Similar to lowering payments in tight times, the policy can easily implode if someone takes a loan against it. The loan against the cash flow decreases the amount of interest gained. A policy loan can actually instantly put the premiums just to maintain the policy in force much higher than ever expected. The decrease or total removal of cash buildup means little or no interest to help pay for the policy. Is your universal life insurance at risk of imploding? You need to find out as soon as possible. The first thing we do is get the most up-to-date status on the account. The main things to determine are: 1, what is the face amount or death benefit? 2, what is the net cash value, including any loans? 3, assuming the premiums stay the current rate, when will the policy lapse or go away? And 4, what is the required minimum premium needed to guarantee this policy remains in force through age 100, 120, 105, whatever the answer is. Based on these answers, you should know if your policy is doing what you need it to do. For instance, if my client is 65 and the answer to the question is, this policy will lapse in 6 years, that is usually a problem. So the required premium number, or the payment needed to keep the policy going, becomes the main focal point. The problem is that the required premium is not always easy to determine, especially from the insurance company. That's because you must stress the word guarantee when getting an answer. You certainly don't want an answer based on hypothetical interest rates and insurance costs again. You want the current guaranteed rate because you don't want to be in the same situation 4 or 10 years down the road. Most insurance companies will give that premium number right to you over the phone, but some will hold out and provide it only in writing through the mail. Regardless, you'll eventually get the answer, and it'll most likely be a premium number that you're not pleased with. Otherwise, your universal life policy would not be imploding in the first place. So now that you know your new premium requirement to keep the policy in force through age, say, 105, you can look at your options. What are your options? Well, a lot depends on your unique policy and your current health situation. In the least, you can now work to maintain your existing policy while you explore alternatives. Now would be a perfect time to talk with an independent insurance agent at Dolphin Financial Group. We'll be able to help you figure out all your options and determine whether or not your universal life policy is at risk of imploding.